Hello everyone, welcome our viewers to the February edition of Fixed Income Outlook. Welcome Kaustubh.
Thank you, Meda.
So viewers, the month of February started with two major events, one being the budget announcement and second being the RBI monetary policy announcement. So while in the monetary policy we were expecting a change of stance to neutral, but RBI surprised us with a rate cut.
Yes.
Kaustubh, what's your take on that?
So look, as you rightly said out, that market at large and even we were expecting a change in stance because of consistently inflation numbers have underperformed what RBI projections were, and in light of the last inflation number, which was flirting with 2% handle, it was expected that RBI will change its stance. What came as a surprise was, I would say, not only they changed the stance, but with the 4-2 vote, they also do a rate cut. And even surprising was the post-policy call with media and analysts was sounded to be a lot more dovish than what market was anticipating. Now, I would say the key highlight for this change in stance and rate cut that RBI highlighted was were I would say as follows. The first one was that RBI clearly communicated to the market that they will continue to focus on headline inflation rather than worrying about the spillover impact of core inflation. The second thing, they clearly mentioned that their target is 4 plus minus 2% instead of targeting 4%, which was the consistent communication over last 1.5 years. Third point, they also communicated to the market that there is no fixed real rate band that they have in their mind. The fourth one, which I think the most important one is that they try to communicate many times to the market that they will focus on growth if price stability concerns are adequately addressed. This is a marked shift from I would say the previous communication that we have seen under Dr. Ujit Patel. On a liquidity part, they communicated that they are looking into it and they will actively manage by various measures and ensure that system is adequately liquid.
Now coming to the union budget announcement, what were the key highlights and how does it impact the fixed income markets?
So this is an interim budget, and the importance is because it is the budget just before the election. The highlight for this budget was the change in terms of trade towards rural India and lower middle class, in the form of giving marginal reliefs to these marginal and small farmers and tax rebate to the income earners up to 5 lakh rupees. Fiscal was kept at 3.4% for this year and next year, as against 3.3 and 3% of fiscal path which they have communicated up till now. The important thing is that gross borrowing and net borrowing were significantly higher than what market is or market were anticipating. Thus, I would say, although this is an interim budget, but and the final budget will be presented once the new government comes in, but in this form, this budget is marginally expansionary for the economy, and since the borrowing amount is higher than what market are anticipating, it would have pressure on the long-term yields of Government of India.
So Kaustubh, in light of what you just said, how do the different yield curves look like on both the sovereign yield and the corporate bond side?
Given both fiscal and monetary policy are in expansionary mode for India, on the monetary policy front, as RBI has projected for next entire 12 months, inflation is likely to be sub 4. We think there is a possibility of another rate cut over next two policy. So the risk to this view is driven by, I would say, the mean reversion of headline inflation driven by food. If the core inflation doesn't turn out to be one-off, or if the crude or energy prices, they comes off pretty fast again at the elevated level. On the fiscal side, because the fiscal policies are also expansionary, it will have some pressure on the inflation part along with the inducement on growth. Thus, we think that the yield curves in India, they are likely to stiffen, and in order to play this steepness in the yield curve, we think that 1 to 3 year corporate bonds, they are quite adequately priced. Not only they provide adequate accrual from the repo or the funding rate, but also they provide an opportunity that in case the RBI cut rates further, there will be a potential of some capital gains. So in light of what's happening on the credit events, there are potential of some mark-to-market adjustment, and thus we suggest investors to stick to AAA part of the curve. In view of this, thus I would say to sum up, the 1 to 3 year AAA corporate bonds is the best place to invest in these light of events.
Now, Kaustuv, with more rate cuts on the card, like you mentioned, which are the funds that investors should look at?
So from a long-term investors, I would suggest them Aditya Birla Sun Life Corporate Bond Fund and Aditya Birla Sun Life Banking and PSU funds. These funds are predominantly AAA corporate bond funds, and given that the yield curve on AAA side is quite attractive, they provide a reasonable accrual rate. For the short-term investment horizon, investors can continue to look upon our ultra short-term products like Aditya Birla Sun Life Money Manager Fund, Aditya Birla Sun Life Savings Fund, and Aditya Birla Sun Life Low Duration Fund.
Thank you, Kaustuv, for sharing your views with us. Thank you, viewers, for hearing us.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.